Hello, good peoples. It is Bruce with Targeted Wealth Creation back at you on a Sunday on your weekend. All right. This one is for my Patreons. It's also for YouTubers. Um, and this one really is to give you some rules and some thoughts on, I call it a strong guide to all that you need to know in a precious metals bull market. For that matter, a commodity super cycle. Now, I'm only going to discuss precious metals themselves and the miners, but I do have a whole allocation video that I'm just about done on what else. Things like energy, oil, natural gas, um, coal, uranium, foods, agriculture, base metals. There's a few other categories that I probably didn't name. So, how do you go about being in all of that? And I give you some examples and some names, and that's only going to be for my paying Patreon members. But because I go into detail. I give suggested portfolios, allocations, things like that. Whereas this is a general overview to give you good information. Some of you guys already know and have been through, a precious metals bull market, a commodity super cycle. And I'll discuss just a tiny bit here. So let me start with saying this. While it's clear to most, we've entered the more exciting phase in this precious metals bull market. And I say that because go look at the last 6 months. Go look at the last 8 months. Look at year to date. You're starting to have a precious metals miner. One week it's the second leader in the S&P. In other words, it's at the highest percentage increase of all companies in the S&P 500 year to date. And that's been New Mining. That is the largest gold mining company. Um, so remember, some of the other miners that have even outperformed it aren't in the S&P 500. Now, I think you'll be littered with companies as we progress through this, but they'll start to get people's attention. It took quite a while to get the analysts to even do things on Newmont. They were all giving it poor ratings, hold, no buys or anything. And that happens in bull markets. Wall Street doesn't have any love for physical gold or really the miners. I always say this, add up the market cap of all gold and silver miners around the world, every single gold and silver miner together, entire market cap of every single one, it's less than any single Mag 7 company. Well, what's wrong with that scenario? Well, what's wrong with that scenario means it's super undervalued. A lot of the metal companies and mining companies today at $3,500 gold have much greater profits than they had in 2011. Yet we're only at about, and what was gold when it last peaked in 2011? Before we went on to new highs continually over the last 18 months. Um, Gold's outperformed the S&P for the last 2 years. So if you look 18 months, people, it's possible it's not a full 2 years, but clearly over the last 18 months. So anyway, likely, where are we in this bull run? People say, well, Bruce, should I even be buying this? You're telling me you got four baggers, three baggers, a five bagger, two baggers. Maybe this thing doesn't have much to run. So that's why I give it related to a baseball game. So we're likely in the third inning, top of the third, bottom of the third, maybe the bottom of the third. So when we do get pullbacks, they can be big and they can be volatile. No different than when you FOMO into Tesla and it runs from 100 to 400 and then pulls back to 200 or 100 again. But I think what you're going to see here is higher highs and higher lows. I mean, some of the tech stuff just stretches so far, but anything that gets massively, when you start seeing a rhino horn shape on a stock chart, look out below. I don't care if it's Hood, if it's Palantir, if it's something you love, very likely it's going to retrace 0.618, maybe zero point 0.5 of that entire move. And it shakes people out. If you time those things wrong, you can get killed, right? All right. So I will, for all of my Patreon people and all the people that are really following me, and in general, I'll do this, but more and more, I'm going to put my really detailed advice and my content in there for my Patreon members. So, but I will keep you up to date as we progress. You know, I put a warning video out 4 or 5 days ago and I said, look out, right? I'm a little worried about things. Well, subsequently, silver stayed above that 40 breakout, and now gold is breaking out. So now I'm less concerned about doing anything. So I just wanted to remind people. I watched the charts, I looked at the technicals to tell me things that I look at, having been through an entire decade of an entire gold bull run, and I've studied every bull run in history. Right? I didn't participate much in the 70s run, right? Where gold went from $35 to $850 and silver went from, 40 cents to $49. Now that's sort of an anomaly with the Hunt brothers trying to capture the market, and the futures market, the only way they could stop that was to come out and outlaw buying. They just said, we're no longer taking buy orders on silver, you can only sell. We'll show you, Mr. Hunts. And so they killed it. They didn't like that, right? And I don't think we'll see that again. I don't think any single individual or entity will try to capture the market like that. So things I look for are ratio changes between the physical, between the miners, between the large cap and the mid cap, and then going into the non-producers down to the developers and the explorers. It's no different in the internet, and we had an internet boom and bust cycle, and it was the bigger companies, and then pretty soon it was anything, and then they said, you know, earnings don't matter, it's only eyeballs. Well, the same thing happens in a really massive bull market in miners. People start chasing any name that has silver in it, even if it's moose pasture they've never drilled, right? It's a lifestyle company by a CEO that's had 6 companies over the last 40 years, and him and his buddies sit on the board and raise capital, never even really drill, just use that to pay their salaries. Yeah, that happens in the industry, right? So you got to be careful. Will some of those stocks double and triple? Absolutely, right? But knowing the difference between the ones that will maintain and sustain is important. So, volume levels increasing or decreasing. All right. So we may yet have some time to run from right here before the next pullback. Again, I'm watching, studying constantly. Reason I say that is gold. I mentioned it. Gold is breaking out from its consolidation since April, right? You had a wedge there going on gold since April. Now it broke out of its high. It's in the low 3600s. Again, when people quote gold, just FYI for you guys, whereas if I quote Palantir or I quote, you know, Bitcoin, typically I just have a price. On gold, you have a cash price, you have a spot price, you have a futures price, right? So when I have screens up, a lot of times I'm looking at December gold, right? That's a month that's very popular. There's usually 3 or 4 of the months that are very popular. They may have 6 or 7 trading months in the futures market. So futures market are a little further out and they have a little bit added premium over what spot might be. So just when somebody's referencing gold price, be aware of that. So this should be very positive for the miners with gold going up. And as gold, if gold continues up, okay, anything can turn and change. But it's reacting, I'll tell you what it's reacting to. It's reacting right now to the Fed rate cut. Fed rate cuts are very positive for the miners. We're now looking at a 95% probability that we'll have 3 rate cuts. You know, a September, November, December rate cut scenario. So they meet roughly every 6 weeks. That's why it fits into the calendar. So silver's recently broken out above 40, and that's showing up in the movement of the silver miners. So rate cuts almost certainly now for September, and the 2 more cuts are super positive. Also, just a little tidbit. Again, I'm not trying to be a seer and somebody who knows everything, but I have subscribed for years to cycle work that looks at history, that looks at velocity of money, that looks at money movement, uses a lot of AI. I won't mention any names right now. And the thought process, okay, and their work is always changing, is telling me that very likely, and you can just see this in the news, that we're heading towards some kind of a peace settlement in Ukraine. Uh, So I feel pretty good about this up movement in gold and precious metals and the miners, and probably in the stock market as well, because that's looking positive. Oh, it didn't completely react that way on Friday. You know, you got the lower jobs number and you had a pop in everything, but quickly it disappeared in the indexes and a lot of the tech stocks, but it didn't in gold and the miners. So again, you're getting a little bit of separation there, right? A recession isn't necessarily bad for gold. It ultimately can be bad for gold stocks. I'll talk about the differences. But that cycle work is saying, hey, there's some really serious debt going on in Europe right now. Germany, France, UK in particular have, not that the US doesn't, but collectively they have a lot of debt. And that debt is forcing some heads of government to be sort of pro war. Well, our citizens and all the unrest, and a lot of it's migratory things that are happening in their countries. I mean, the social spending in France alone is unbelievable, almost leads the world. So that in turn has hurt their debt cycle. So without getting too deep in that, I'm watching for a goal move up through September into October, and likely we get some kind of peace settlement, right? That happens mid to late October, maybe early November. These things take a while to all sort out. And when and if that takes place, I see that causing the war cycle, the fear cycle that gold also moves up on. If you weren't aware of that, when things look bad, a lot of people move to gold. When war is constantly out, whether Iran, the Middle East, Ukraine, China, Taiwan, whatever, that fear keeps gold and central bankers, along with the debt. I'd say the biggest thing is just the debt levels of the first world countries and mostly Western countries. So let's say that happens. You get a peace settlement late October. That could turn around and take 10% off the top of the gold price and cause the miners to pull back as well. I don't see any way, shape, or form that peace stays. I think the European government heads and their backing of Zelensky and some of that, not getting into politics, guys, just calling it geopolitical. I don't see them really wanting peace. If they did, they would have honored the Minsk agreement years and years ago. So I just see this as, you know, some rationale. You're starting to see a big push for them to put peacekeeping troops in, heavy and large numbers of troops to guarantee peace seeking. I don't see that working out. So even any limited settlement, I think turns around and we go right back to the war in 2026. So I'm not too concerned for any, again, it's just a hiccup along the way. But that could be a triggering factor, guys. I'd love to just tell you some of my thought things. Okay. All right. So let's get off that because again, that's, a few people's opinions and subscriptions I have and some thought processes of people that are well in the know, but it doesn't mean anything's going to happen. So what investment strategy in general works best in these bull markets? Well, plain and simple, I've mentioned this to my paying group before. Buy, hold, and trim. Now, what does the trim part means? That means take some profit. Let's say I got a position and I'm up two and a half or three times. Trim a little bit of money out. Now, some will say take your investment out. If you got a triple, take your investment out. I don't always do that. I may only take 50% of my investment out. Part of it depends on, but I don't ever want to get set up where, I'm outsized in a single position. Let's say I've got 8 explorers, the little guys, and I got one guy that's up 20-fold and my other ones, out of let's say I got 10 of them and one of them's 20-fold and we're only in the 5th inning, but I got, 9 other ones that collectively are doubles when you add them all up, right? Some barely up, some up 3. And so all of a sudden, I'm outsized in that big guy. I really need to take a large percentage out and then spread it over others, as long as I think we're still in the 5th inning with a long ways to go. So, things like that. How about a strong selection or stock selection fundamentals? Okay, what did I do here? Selections, I'm buying, owning. I messed up something here, guys. I was cutting and pasting some of this data. Let's see, what do I need to do? That's not fixing it. Yeah, I'm not sure. Let's see. I'll continue to share in Patreon selections what I'm buying, owning, and holding as I uncover new opportunities or changes in miners. All right. So, mining stocks are physical metals. Well, both. Okay. You see down here, I say own both. Now, without telling you exactly how to construct your portfolio, again, I'll say early on, I'll describe every bull cycle and bull market in precious metals that I've studied and or participated in. Okay. You can go back historically and look at these. So early on, first inning, maybe even into half of the second inning, gold usually is a big mover, almost always the big mover. Miners don't wake up yet. So the miners then wake up, which we're only arguably 6 to 8 months into the miners waking up. And then they start to outpace the movement of physical. It can go 2 to 1, 3 to 1, or more. I'd say over probably even 2.5 over the rest of the bull market run. So you're going to make more money in the miners, but guess what? The miners are also stocks. So if we have a big market pullback, and this is, oh, we're in a deep recession, we could go into a depression and there's fear. The physical metal, I'll give you an example. Remember the 2007, 2008 Lehman Brothers? All of that kind of, it was really into 2008, but we were peaking in some of the metals and some of the other things in 2007. It just wasn't very visible. Then 2008 came along. I was playing silver. I was really moving on silver a lot. And I had to pull back because I saw then what was happening. So when you get into that kind of scenario through the rest of 2008, I mean, gold depends on which dates you look at, but I round it. Gold went from $1,000 to $700. Gold went down 30%. Gold stocks, I had some gold stocks down 60%. I had some gold stocks down 90%. So stocks, the baby gets thrown out with the bathwater. You get a margin call, it happens there. Margin call doesn't typically happen on somebody who owns physical. Now, if you own physical in GLD or SLV or some of those big artificial owning, I mean, they work, they're liquid, but those get hit. But when you have physical gold, you don't really get hit. You don't go and look. I mean, you look and you see what spot is, but you're not cashing that in. You're not trading it like a stock. You're not borrowing against it. Okay. So typically, say in the seventh to eighth inning, now we're back talking about, physical or whatever. So early on, then the miners wake up. Silver as a metals play catches up like it's starting to do now. So the big mover has been gold, right? Gold's more than double. Silver hasn't doubled. Silver isn't even at an all-time high, right? Say it's $41 and change. Silver was $49 in April of 2011. It was it was $49 in 1979 of January of 1979. Kind of an outlier, but still. So just by inflation adjusted, silver should be close to $100 for the 2011 number. It should be about $160 inflation adjusted for the 1979 price. So you're talking about typically when does silver really run? And I can tell you to go out and look at charts. So typically in the seventh inning, maybe the bottom of the seventh, in any typical bull market in the precious metals within a commodity super cycle, seventh inning, silver goes into a blow off top, right? So look at 2009. It was probably the latter half of 2009 into that April 2011. Silver went up to $49, probably from under 20. I think silver got down to $7, something like that, in 2008. So you're talking 7 times in 18 months or something. And that's the kind of stuff that happens. And then if it runs like that, it's typically a blow off. I'm not exactly sure. Now, we could have a blow off in silver and run up to $250 and then have it pull back to 100 and stay at 100 for 30 years, right? Because silver is scarce. Silver is used. It has that monetary side. It becomes a proxy for gold when gold gets to 5,000, 6,000, 7,000. People want to buy silver because it can't buy any gold to make that much different. What do you do? Buy 1/10 of an ounce or something, or grams? You know, for me, the lowest amount I own is an ounce, right? A pure 0.999 ounce. And even that now at 3,500 in gold, it's harder to barter with that. So silver could become to have a barter situation if, we went off the power grid and all that. But that isn't my point to discuss here. So, but I did want you to know, and then that same thing happened to silver in the 1978 to 79. Right? It just blew off like crazy. All right. So if you want to own miners, this isn't to give you a sample portfolio. This isn't to recommend, because this is my general video to everybody. But there are, if you don't know, I probably should have colored these in. But GDX is large cap gold miners ETF, more stability, lower growth potential, typically 5 billion plus. But you know what? In a bull market, and we're still in it in the third inning, there's probably still 3x, in other words, 3 times their current price left in many of the top name miners in GDX. You may have a four bagger left in there. So you typically have 3 to 5x in these stocks from the beginning of the bull market to the peak of the bull market. And those are your low risk, relatively. They're already producing. Typically, they have good management teams, some better than others. I talk about all that on my Patreon and give recommendations of which one I like the most. And then your juniors aren't really juniors in the sense that they're little tiny explorers or developers. They're 1 billion to 5 billion. These aren't your little, these are mid tier and smaller tier producers. And typically, these have much more upside. These could be 5x to 8x, okay, despite the junior name. They're 3 to 5 billion. And then you have some other ETFs, like I've always followed UserX, USERX, has a lot of global, includes the Australian miners. GoX is another, GOEX, right? So they're kind of an alternative composition. They just own a bunch of miners. They mix late stage developers with small tier producers and all that. They just give you a broad spectrum. And then when you want to get silver focused, which is where we really are right now, because going forward, silver should have outsized percentage gains. Right now, gold is breaking out, silver is breaking out, but silver percentage wise will run harder than gold. But the big move in silver doesn't come late. When you see that crazy run in silver, you know we're in the seventh or eighth inning. All right. So you got senior silver miners, 2 billion plus, and then you go down to, again, probably a misleading name. They ought to call it mid cap silver miners or mid cap gold miners, right? Instead of junior, because junior can be a misleading term. Under 2 billion, higher volatility. Okay. So this diversity allows investors to tailor their ETF selection to specific market views and risk tolerance levels, guys. So www.patreon.com// TWC 100. That's my, if you're interested in Patreon. All right, what else? Now, I've put this out in various forms for my paying members, but here's the concept, but I give them some sample portfolio. So how do you go about allocating your percent of money across all this stuff? Well, I'm not going to give you a complete um, story here, but I'm going to make up some number. Let's say you have $100,000. See, you want to put $100,000 in the precious metal space. How would I do it? What do I think the best way to do for anybody? This has all come from learned and experience. Is go out. Okay, probably I haven't subscribed to this. It depends on my own fear and greed scenario. But you probably ought to own maybe a third in physical and maybe two-thirds in your producers. But again, that depends on the individual. I know at times when I've been 50% or more in physical, man, I sleep well. But I also don't like it when I'm not making money. I'm actually thinking of selling some of my gold, even though I think it could go to 10 or 20,000 from where it's at now before we're all done. I think 75 is a shoe in. I just absolutely believe we'll see 7,500. All these other numbers are just plus beyond that. Okay. So own some of that, but own the miners because they're leveraged, and I'll explain why they're leveraged down here. So, but I was waiting for somebody to say, well, how much of which? If you say 70, 60,000 of your 100, you figure it out, right? Because that just varies from your thought. Stackers and people like that are going to say, oh, put 70% in the pure metal. Well, you won't make as much money. That's what I'm really saying. Okay. So when it comes down here, I'm talking about producers. So the kind of producers I think will make you the most money, but they're the hardest to discover and sort out is the mid-tier producers. But all producers, all metals, precious metal miners that are medium and large cap producers all have an advantage over any other mining category company. And that is number one, they're making money today. So they have leverage to the metal price because they have a certain amount of cost. As that metal price rises, they make more profits. If you're making t-shirts, t-shirts just don't rise up in price. That's just not something that necessarily happens. You may make a design or a trend that's popular, but generally t-shirts don't rise up. Well, if you're a miner, you don't have customers. All the gold that you can mine or silver, there's a waiting buyer for it. You don't have to go out to market customers and say, hey, look at my t-shirts are the best in the world, right? So it's a whole different kind of business than really most other businesses. I don't want to deep dive on this. So, and really all three categories, small, medium, and large, have that advantage. The second thing that they can do is they can go out and acquire other gold miners that are smaller than them and just buy them. They're basically buying ounces in the ground. Say it's a late stage developer, they've got a permit, they're getting ready to raise the fund for mining, and in comes, Newmont or Anikio Eagle or Barrick, or, I could go on with names. And they say, oh, what's the ounces? Oh, we have a mine right there. We've got two big mines within 5 or 10 miles. We could just, maybe it's open pit. Well, we could just truck over, their ore and process it in our mill until we're ready to build an additional mill. So there's economies of scale. There's all kinds of things that they can do that somebody that's just starting an explorer or developer can't do. Okay. So they just have some inherent advantages. And so I look for mid-tier, aggressive, CEOs and those that really want to grow. And I like it if they have high inside ownership. Okay. Which is harder when you get in a big cap. You want a smaller cap so that I know they're committed to the company and they're not just looking for their next gig. You want a CEO that's experienced, who's built huge corporations and maybe jumped over a small one and they didn't need him anymore because they're the largest gold company in the world because they bought 20 gold companies, right? But he still has that thrill of building it. That's where you want to get into a mid tier. When they got a top tier management company, they got a CFO, you know, and maybe a president knows how to go get money, right? You need funding when you're a mid tier and you want to expand. What if just your land package where you're drilling for more, you're producing a lot, but you want to drill out the rest of your land package so that you can grow your reserves? See, when I say businesses aren't like any other business, they eat up their own, right? So if they've got a 10-year mine life, and they got three mines, and, what are they going to do after 10 years if they're not drilling and finding new or acquiring or doing whatever? So there's just certain things that take place. All right. So that's why I like, and in particular, I like that mid-size because they're really proven up and they're very likely if they have an aggressive CEO and management team of wanting to go out and acquire. Now, what I started to say about insiders, when I moved to this stage, why is this lower? Well, look at the risk. This is what I call low risk. They're already making money. They're just going to make more money as the metals move up in price, and as long as they keep running their operations efficiently. Okay. And medium risk, because these are what I call later stage developers. I don't tend to go and buy in the really small first level unless they look like they're onto something. Let's say they're in the Yukon and they're right next to some bonanza grade, discoveries over the last 50 years where, millions and millions of ounces have been produced and they got a great land package. They're drilling, just early drilling says it's high grams per ton. It looks like a fabulous company. The management team's experience. I'll throw a little bit of money at that type of developer, but it's got more risk, but it's also got more potential upside. If these guys are 3 to 5 baggers, these are 10 to 20. So I want to allocate here across as many names as possible. So if this is, say this is $25,000, I may want 15 names and I divide 15 into 25,000 and it tells me, I don't know, the math, $1,250 a miner or something. You do the math. I want to own as many as I feel good about, not just throwing a dart at a dartboard and picking them. Okay. So things there I look for: skin in the game, high ownership, right? Inside ownership. Does the board and the CEO and the management team own shares? Are they committed? Or as soon as that, some more drilling results come out, are they just going to go sell it to a big gold company, to a Newmont or a Barrick, Nikio Eagle? Are they just going to sell out? Because they sell out, they're probably going to make 70% on the current stock price, 50% increase. They don't get a 5x on it. But they also, in order to get that 5x and that 10x, they got to build the mine. They got to finish discovering it all. They have to get all the permitting, right? It's a multi-year process for them to go through those stages. Look at what's called the Lassonde curve. Pierre Lassonde was a former CEO of a gold company and developed that. Lassondre, I think, Lassonde curve. I've got copies of the Lassonde curve. I've been meaning, but it's a complex, it's kind of an S shape on how these explorers and developers go through and why they have these change and price things on their end. But you need to kind of understand that if you're really playing in this. So I try and do the work myself to help my base of people. I'm hoping to have a product out in the next 2 to 3 months that'll allow you to search. It'll be a website with a sophisticated database that you can put into parameters, and it ranks and rates and does a whole lot of things. Because I just feel that I don't need you dependent on me every step of the way. I'm not one of these guys that said, "Hey, buy this closed-end fund, and you got to listen to me every day, and you got to be in the Discord, and I know it all, and all that stuff." No, I can teach you guys enough that you can take some of this stuff and you can run with it. But there is an art and an expertise into understanding this. I've been involved with it for over 25 years now. And in markets in general, with options and all kinds of things for 45 years. So this is just a sector, an area that I found in the late 1999, 2000. So I know it well now. And then the third category, explorers. And the reason that it's a small percentage, because now the risk is even higher. If these guys are 10 or 20x, you literally, on a good one of these, can get a 50 bagger or a 100 bagger. But I wouldn't say it's luck, but you could pick 10 and have 8 do nothing and have one of them go up 50x and you're ahead of the game. But if don't take that logic and say, well, I'm going to go dump all my money, I'm going to spread it over, 40 explorers. It just isn't a good way for it to work. There's just so many things that can happen to go wrong here, guys. But it's worth owning some of it, right? And that goes back to, do they have skin in the game? There's all kinds of metrics. When I have this database complete for ranking and rating, this is easier. Up here, it has a lot to do with what is their ASIC, their all-in sustaining costs. What about the management team? Have they done it before? Do they have experience? What's their PE ratio? Are they a big mine or a small mine? A lot of times when you're investing in something, if they don't have a big upside, if they're only going to be a, million ounce producer and that's all they can do, and they don't plan on buying other companies, I don't know that I want to fool with them, right? I want somebody that's maybe got 4 million, 8 million, 10 million already inferred and discovered, and now they're producing, may only be producing a few 100,000 ounces a year, but that's how much other resource they have in the ground in their mines. So they're just going through the funding cycle and they're working their way through to grow themselves, let alone add. Okay. But when you're down here, you better be in the right area. Oh, and I didn't even mention, guys, you want to look at all of this stuff. Another important thing is geographic location. Are they in a high risk place? Sometimes I'll go take a medium risk geolocation that normally I wouldn't want to be in, but they've identified just such a rich asset that I say, I'm willing to take a little risk. I own, 50 miners, so I'm adding them. I've got a small capital percent of the allocation. So there are times and there are situations for some of that. All right. Let me wrap this up. So what eventually causes miners, or why do miners outperform the metal itself? Why don't I just go buy metals? I've been stacking metals. My dad stacked metals. His dad stacked metals. Because guess what? Mining companies offer operational leverage to the metal price. So let's take an example. So when gold or silver rises, all right, their profit margins expand disproportionately. What do you mean by that? So take a gold miner with an all-in sustaining cost. Now, the only thing they have on top of that might be taxes, some other kind of overhead, but that's generally all of their costs for equipment, people, and extracting the metal out of the earth, right? But taxes, they don't have big marketing budget. Yeah, they go to a few trade shows, depending on the size of the company. They have an HR aspect if they have employees, but in general, they don't have huge expenses. They can in certain moving to production for equipment and building a mine, but let's say that they have an ASIC of $1,500 per ounce and we're at 3,000 gold. Okay. So their profit right now on their gross profit is 1,500 per ounce. What happens when gold goes from this 3,000 number to 4,500, right? So it does that in a way that their ASIC, maybe it went up 1 or 2%, but let's assume it's the same. So let's say it's still 1,500. So they were making $1,500 per ounce of gold. They just doubled their earnings. They just went to 3,000 instead of 1,500. So it went up 200% increase. So it's 100% net on a 50% rise in the metal. The metal only went up 50% from 30 to 45. That's what we mean by leverage, guys. And this happens in all miners and all metals, right? By the metal itself. So I don't see how we're not at, we could hit 4,000 this year. I think we're headed to 38 to 39 in this breakout that we're going through now. That could pull back, probably be 5,000 late 2026, worst case, probably first quarter of 2027. It's just too much debt in the world. There's too much central bank movement. Retail's not even buying it. You guys in North America, you're not even buying the miners right now. You're not even buying the metals. So if we get less than 1% of all the money that's FOMOing into the Mag 7 and into the NASDAQ and all the FOMO, just less than 1% of that money moves into the miner. How can it not when they start looking at the success? Then that in turn will raise that. That'll make the fifth and sixth inning and that'll move all of this stuff up. So that alone doesn't make the raw metal go up, but that makes the miners have multiples, right? So how does the market correct? This is a final thing here, guys. How do market corrections? Because I think you ought to just have an idea. You have an idea in other assets. If you're talking crypto or you're talking, S&P 500 or whatever. But so in the metals and the miners, the corrections often see the metals pull back to key support levels. That's true of any stock while maintaining their overall uptrend. You want to see higher highs and higher lows. You don't want to start seeing big lows, right? You don't want to see oversized downsides. So miners frequently, and they've already been doing it now, lead both the downside and the subsequent recovery. So you get this insight into the early signal of the trend change. During healthy corrections, trading volume typically decreases during price declines and increases during rebounds. So, kind of common sense trading experience. It's not totally unique, but like I said, sometimes I look at sentiment. Sentiment and valuations are still extremely low. And I base that on where gold is, or I'm sorry, I base that on where your miner, take GDX. It's in the 60s still. It was in the 60s in 2011 when gold was $1,911, the highest it hit. Okay. So why are we still in the 60s now? Because the public is not in this sector. We're net selling in GDX. It's coming from other parts of the world. It's not coming from North America. It's coming from India and China and a lot of other places that value the metal. Oh, it will come from the retail. But typically that takes a slowdown. Once people see that you don't buy the dip on the Nasdaq 100, you don't buy the dip on the S&P right now. I'm not saying don't do those things. You're a 40-year investor, you want to stay invested in those indexes, that's fine. But for me personally, I know just like I did in the 2000 decade, it outperformed the S&P 500 by a 3 or 4 factor during the entire decade. So that's how I was able to get 8 to 10x on my money after the dot-com bust. It took 15 years for the NASDAQ to get back to 5,000. So sometimes you have those issues. I don't see a 29 crash, but could we get a 30 or 40% withdrawal, retrace on the current levels? Sure. And we may even cause the miners to go down again, the baby with the bathwater. You get too much margin calls, you get too much pressure. The metal stocks will get knocked down a lot more than the metal itself if that happens. But I'm still not seeing that exactly. I just see debt levels and I see central banks just buying so much physical. I think there's no way really. And even if stocks get knocked down, they're the very first to correct back because they really represent value. All right, guys, I've gone too long already on this. My Patreon is on there if you're interested in that. Hopefully, this is enough of a teacher. I know a lot of you guys know I like to teach, I like to show and tell and do that. It's just one more. I've done several like this, and this is good for everybody. Wake up. If you haven't seen this and you don't understand this, you know, stop chasing what everybody else is chasing and start getting into something. Just go look at 6 months. I was doing videos in May, I was doing videos in June, okay, on miners. A lot of those are up 100% more from then. So understand where money is moving and don't be just one sided. Don't just believe I'm in NASDAQ and I'm in this and it's buy every single dip, it's going to the moon. Because nothing goes straight to the moon, guys. It's already gone to the moon in the last 15 years. I don't think it's got a 10x in it, but I see a lot of 10x here. All right, guys, this is Bruce with Targeted Wealth Creation, not a financial advisor. This is not financial advice. Have a great one. Talk to you later. Bye for now.